You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Fevertree, Playtech, AG Barr, Flutter Entertainment, Carnival, and McCormick. Sam, shall I kick us off with Fevertree?
Absolutely. The show's favourite tonic maker.
Absolutely. That's right. So the show's favourite tonic maker had their full year results out this week, with full year underlying revenue growing to £364.4 million, which was up 6%, ignoring the effect of exchange rates. And this was helped by 24% growth in the US, which offset a small decline in UK sales. Market share grew across all key regions. Underlying cash profits, EBITDA, fell 23% to £30.5 million, with high exposure to elevated energy costs for glass bottling and inflated freight costs over the years, squeezing the profitability. Free cash flow worsened from an inflow of £3.9 million to an outflow of £6.4 million, and net cash dropped 37% to £59.9 million at the year end. The 2024 outlook has been reiterated, with the group sales set to rise by around 8%, and underlying cash profit margins are expected to rise from 8.4% to around 15%. A final dividend of 10.9 pence per share has been announced, and that'll take the full year total to 16.64 pence, which is up 2%. And the shares were up around 1% in early trading. In terms of valuation, Fevertree has a market capitalisation of 1.35 billion and trades at 31.6 times forward earnings, which is below the 10-year average of 46, and it has a prospective dividend yield of 1.8%. I thought these results were encouraging, particularly when we're looking at the US, and I think that's when we've covered Fevertree, the number of times that we've covered it is really the key focus for it. Obviously, it does have short-term, or well, maybe medium-term headwinds with the volatile energy prices and the bottling, and obviously some inflationary issues when it comes to freight costs, and that has been the case really since COVID. But I think the key thing is continuing to deliver in the States, and you look at that eye-watering valuation. But if it really can crack the States, then that, would come down. And this, what is, I suppose in the UK, it's not a small company, but it's only got a market cap of 1.35 billion. It could have, huge potential growth ahead of it. And I guess you would say that that's reflected in the price, and it'd have to be quite brave to buy it. But I think it's encouraging the way it's going, and I do like it. Not sure that I'd be brave enough right now to buy shares, though. Sam, what are your thoughts on these results?
I think they're really good. I think 80% of the sales are bottled with glass, so they are at the mercy of energy prices. I think they've done well. I think UK, it's a very slight decline, and the UK it's not really going to move by a huge amount year to year. They're pretty saturated. It's not really a growth market. It's kind of job done in the UK. They just really need to hold on to what they've got. The US is the exciting one. I think the US now is getting to be about the size of the UK in terms of the size of the sales. And then that's growing 24% a year. It's growing off a bigger and bigger base. And like you said, that is the exciting area. I think they've shown over the past sort of 4 or 5 years what a good operator they are. I don't really have any issue on the cost side, just because I think the costs, in terms of the cost, it's going to be quite cyclical. When energy prices or bottling prices are low, the costs will come down, and when they go back up, they'll go up. And that is just the nature of the industry that they're in. But if you look at the earnings per share, they're down about 2/3 from where they were 2 years ago. And that's because they've been squeezed so much on the margins. So if you do take the view that the costs are cyclical and the margins will get back to the levels they were, and the margins did used to be pretty good. So in 2021, they had an operating profit of 55 million on revenue of 311 million. It's about an 18% operating profit, which is pretty decent. If they were able to get back to those kind of levels, And bearing in mind that revenues, it's not loads bigger, but it's gone from 311 to 364. But then you've got that US, which I think is going to be basically snowballing. I think you could make an argument it's quite cheap if you think the margins will get back to what they were. But it could then instead be on like 10 or 15 times normalized earnings if you were to assume those margins recover. But then if you add in the US growth on top of that, I think for someone who believes in the business, it's actually very, very cheap at the moment.
Would you be buying shares?
I'd be tempted. I do really, really like it. I just don't know if there's other businesses I'd buy first.
Sure.
But because I think there are still risks there. But I do really like the business. It is on the watch list. It's been on there for a while. I don't know if I'd be ready to buy at the minute, but I don't think it's unreasonably priced.
What about Playtech then?
So Playtech, so it's in an industry we've covered before, but we've never covered the stock. So I thought it'd be interesting. We've got a couple of gambling themed companies this week, and that's because we normally do Entain. We do that fairly regularly, which is quite interesting. So I think we've never really looked at the other ones, just mainly because neither of us would ever actually invest in the gambling industry. Well, I thought it'd be interesting to take a look anyway, because some of you guys might.
Absolutely.
So Playtech have come out with their full year results, and Playtech is a gambling software development company, and they provide software for online casinos, online poker rooms, online bingo games, online sports betting, and scratch games and mobile gaming, as well as live dealer games and fixed odds arcade games online. They're listed on the FTSE 250 after originally listing on the AIM in 2006. And they're now the world's leading and largest international designer, developer, and licensor of web and mobile application software to the digital gaming industry. And their customers include William Hill, Ladbrokes, Bet365 in the UK, and Snea and Sisal in Italy, as well as governments and regulated industries. So they have come out with their full year results, and all these figures are in euros because I think they must be based in Italy despite actually being listed in the UK. But revenue was up 7% to 1.7 billion euros. EBITDA was up 9% to 432 million. And these are all the adjusted figures. Post-tax profit was down 2% to 156.8 million. Diluted earnings per share was down 3% to 50.2 million. And net debt was up 3% to 282.8 million. So they've also highlighted that 3 US live casino facilities are now operational and they're licensed in 11 US states. So quite similar to Entain in that, although it's more of almost like a picks and shovels play, they are benefiting from that US growth. They've highlighted the resilient balance sheet with leverage of 0.7x at the end of 2023, despite impact from Caliplay. In business to business, they've said the Americas was the biggest driver of growth, with revenue up 46% to 211.9 million. In Latin America, Caliplay in Mexico remains a key driver, with Wplay an increasingly large contributor. The performance of Galera Bet was encouraging as Brazil takes further steps towards regulating. They've said they're well positioned to take advantage of significant growth opportunities in the US, with several operators launched in the year across multiple states. A third live casino facility opened in Pennsylvania and they're licensed in 11 states. They've had an excellent start to the expanded relationship with North Star in Canada, which saw strong growth. And the live casino continued to see good revenue growth. The company remains focused on the regulated markets, which saw revenue growth of 24%. And they've also highlighted in business to consumer, the Snea brand maintained its number one market share position across Italian sports betting brands in 2023. In terms of the valuation, the business is quite cheap, trades at a P ratio of 10.3. And over the last 5 years, it's been fairly lumpy, but revenues increased from 1.44 to 1.7 billion. I don't think this is a terrible set of results. I think it's pretty similar to Entain, where if you do believe in that US, revenue up 46% is really, really impressive. So yeah, I think if you believe in the US, it's probably not that expensive. I think 10 times earnings isn't that expensive for what seems like a good software business. I don't know enough about the relationships between them. I'm given by the fact that all their customers seem to be the biggest players in the market. They seem to have pretty good relationships. But I don't know if I'd feel more comfortable with a sort of almost like a direct play on that US market with Entain or a more direct play. I wouldn't invest anyway because I don't like the industry, but I think it does look interesting. It does look fairly cheap if the US growth can continue to do what it's been doing, as we've said when we've covered Entain. John, what do you think?
Yeah, they're fairly similar. It's not an industry that I'd invest in, but the company looks like it is doing very well. I was just reading about the founder. Apparently, he is Israel's fourth richest man, and he's married to Miss Israel from 2006, 7 children, has Playtech, which he founded about 25 years ago, and I think it IPO'd on the LSE in 2006. And he's also been he buys up quite a lot of VPNs. So he's got ExpressVPN, private internet access, ZenMate, and CyberGhost. But looks like quite an interesting chap, and then owns quite a lot of Camden Market. But anyway,
Oh,
quite the entrepreneur. But no, I think interesting company. If we compare it, maybe keep an eye on it and see how it does in comparison with Entain, and see how that theory plays out on it.
right. Shall we move on to a business that's grown on us over the years?
Absolutely. So, I mean, we previously felt that Britvic was the show's favourite soft drinks maker, not tonic maker, but soft drinks maker. I think that perhaps has moved in recent months to AG Barr. They've had their full year results out last week with, and they're pretty good. Strong brand momentum, delivering volume and value growth, with like-for-like revenue up 8%, and revenue, including a full-year contribution from the Boost portfolio, is up 25.9%. They've successfully delivered 1 year of their margin rebuild program, including an initial contribution from the first phase of Boost/Rio production insourcing, which commenced in November 2023. Adjusted profit before tax came in at £50.5 million, which was up 16.1% on the prior year. And strong cash generation and the robust balance sheet came in with net cash in the bank of £53.6 million after significant investment in the business and the £12.3 million acquisition of Rio Soft Drinks in October 2023. Group have announced full year dividend of 15.5 pence per share, including a final recommended dividend of 12.4 pence per share. Good progress on a number of fronts in the first full year ownership of the Boost business, alongside the acquisition of the Rio Tropical Fruit Drinks brand, and the margin rebuild planned well underway, accompanied by strong cash generation and balance sheet strength. And across the period, the total UK soft drinks market increased in value by 8.3%, whilst volumes declined by 2.9%. And these trends were similarly reflected in both the carbonates and stills subsectors. The high level of price inflation prevalent across the market in 2022 continued into 2023. However, the scale of these inflationary increases eased somewhat in the latter part of the year. The group's soft drinks portfolio, supported by their brand building strategy and pricing strategy, delivered both value and volume share gains in the period. In terms of the cocktail business, so this is sort of funk and cocktails, the on-trade channel remained variable across the year, with late-night venues in particular experienced reduced footfall in the context of consumers feeling the impact of the increased cost of living pressures. But despite these tougher market conditions, the value of cocktails remained flat at £688 million, and cocktail penetration increased. 1 in 5, 9.4 million, on-premises UK customers now drink cocktails out of home, and a 0.2% increase on the prior year. Cocktails have been the main growth driver in the ready-to-drink category, increasing in value by 19.2%, more than 4 times the rate of the ready-to-drink category as a whole. Funkin remains the number 1 ready-to-drink cocktail brand within this growing sector. In terms of MoMA and the plant-based milk market, the value of the plant-based milk market has grown year on year by 1.2%, with volumes down 8.6%, and it's now worth £369 million. And oat milk continued to be the key driver in the category, with volume growth of 2.9% and value sales up 12%, compared with value declines in almonds down 11%, soya down 7%, and coconut down 11% in terms of the milks. Oat milk share of the total plant-based milk market increased to 59%, up from 53% in the previous year, with 21% of UK households now purchasing oat milk. MoMA grew significantly ahead of total plant-based milk market, with sales up 37%, driven by its specific focus on the growing oat milk subcategory and its strong brand momentum as well as distribution gains. And they draw particular attention to energy and sports, which continue to be the fastest growing subcategories within the UK soft drinks market, up 16.4% and 54.8% respectively in value terms. Boost brought strong incremental sales to sport drinks, and they say that they now have greater scale and presence in energy as they combine the Boost brand, Rubicon Raw Energy, and the new energy innovation in Power Brew. In terms of valuation, AG Barr has a market cap of £646 million and it trades at 16 times forward earnings with a prospective dividend yield of 2.8%. I thought these results were good. I think they've definitely been outperforming Britvic. And I guess in terms of comparisons, they've got a much, much smaller market cap than some of the other soft drinks makers and particularly some of the other consumer goods companies. But I do quite like them. I think they're doing a lot with decent brands. They're not the very top, but they are delivering, and it looks like this is continuing. I think at 16 times forward earnings, it's certainly not outrageous with the margins that they have. And it also does have a growing dividend yield, which is not insignificant either. So yeah, I do like AG Barr, and I think probably it has pipped Britvic to becoming our new favourite soft drinks company on the British-based soft drinks company. Sam, what are your thoughts on these results and AG Barr?
I would agree. I mean, we did look at the trading statement a couple of months ago, but that was much lighter on detail. So it is good to see how they're doing, especially the new, or not, they're not that new now, but the more recent acquisitions as well. I do agree with what you say about the brands not being as good. I think if you were to go through the Britvic brands, you could pull out 10 really, really top quality brands. With AG Barr, it's probably more 2 or 3, but they are delivering, like you've said. And I think in recent years they've seem to have made some smart acquisitions. I mean, you just, if you go on a train on a Saturday, you will see, it's basically like a free advertisement for Funkins cocktails, and that does seem to be very popular. So yeah, I agree. I think it has grown on us. I think it's been helped by the fact that Britvic hasn't been performing. One of the most exciting things about Britvic for us was the opportunity in Brazil, but then the results have been quite disappointing. And then the brands they have, it's not the Britvic brands in Brazil. It's they've gone and acquired local brands, so it's not like they've gone over there with Pepsi or something. So yeah, I think for me it probably has, maybe in the last 6 months or so, probably my preference probably has swung to AG Barr, but it's a good little company. It's not that expensive. It's putting up good results. I think yes, it's not got this sort of portfolio of fantastic brands yet, but it is doing very well with the brands it has, which I'd much prefer, I guess, than a company that's doing poorly with better brands. Because as we've seen, for example, from Unilever, that can go on for a long, long time.
Yeah, no, absolutely. And then innovating in terms of the energy and the Iron Brew, the sort of energy version of the Iron Brew drinks too.
Yeah, exactly. Yeah. So I think if they can continue what they're doing, hopefully we'll be sat here in a few years' time. And actually, they've maybe got sort of 4 or 5 brands that you're talking about and saying, well, actually, these are top quality brands. And, hopefully they're doing the right things and making those investments to get there. But, I think if I was a shareholder, I don't think I'd really have anything to complain about with these results.
No, absolutely.
Or even the price either.
No, that's right. That's right. Do you think because it is such, well, I say such, it's a much smaller player that's, coming into the valuation there?
I think so. And I think it probably because it is UK based, it's not really international. And soft drinks is such a difficult market to gain market share in. It is probably one of the hardest markets to gain market share in, actually, because it's not just Pepsi you're competing with. You also compete with Coca-Cola.
Yeah.
So to actually go in there, which is why I think it makes sense with maybe the energy drinks and sort of the funkin' cocktails, where these markets are probably a little bit easier. I think what they're doing smart. But yeah, if they're saying, yeah, well, we're going to have, one of the top 3 soft drink brands in the UK, it's actually really, really difficult. So I think that's possibly why, because they are in just such a tough market that, if they were doing it, could they do this off a bigger base? I don't know. It would be
Yeah.
much, much tougher, just because of who they're up against.
Yeah, no, absolutely. Absolutely. Okay, on to the second gaming related company this week.
Yes, so we're now on to Flutter Entertainment, and they were formerly Paddy Power Betfair, and they have Paddy Power and Betfair, and they are a gambling company listed on the FTSE 100. They also have brands including FanDuel, PokerStars, Sky Betting and Gaming, and Sportsbet. I didn't realize that Sky didn't have the Sky Betting, and they've highlighted as well on this is on Why Invest on their website. But January 2020 to January 2021, so that was a COVID year, revenue grew 106%. And then from January 2021 to January 2023, they've had a compound annual growth rate of 32%. So this is very much a growth industry, as we've seen with the other gambling companies that we've covered. So they have come out with their. Oh, I should mention as well, actually, that they're dual listed, so they're listed in the US as well. So they've come out with their full year results, and all these figures are in dollars because they're listed in the US as well, but they are listed primarily on the FTSE. It's a secondary listing in the US. So their average monthly players was up 20.3% to 12.3 million. Their revenue was up 24.6% to 11.8 billion. They had a net loss that was worsened by 227.3% to 1.2 billion. That's not as bad as it initially looks, because it's mainly due to a trademark impairment of PokerStars and amortization of acquired intangibles. So that's where they paid for something and they have to write it off over time. And then the PokerStars one, it means that they've got a trademark that was on the balance sheet, and the auditors come in and decided the trademark's not worth as much as they thought it was. But in terms of cash, nothing's actually gone out. Although if the brands are worth less, that's obviously not good either. But they have adjusted EBITDA if you adjust those out, they've said the EBITDA was up 45.4% to 1.87 billion. The net cash provided by operating activities was down 19.4% to 937 million. And the leverage ratio was down from 4.4x to 3.1x. And they've said US business is rapidly scaling, with revenue up 40.7% and first year of positive adjusted EBITDA. Product innovation helped add 3.7 million new customers at attractive projected payback periods. They've continued the number 1 sportsbook position with sports net gaming revenue share of 53.4%, and that compares to 43.2% for gross gaming revenue. FanDuel is the number 1 iGaming brand as of January 2024, and the US gross gaming revenue share is 25.7% in 2024, in Q4 2023. They said their strong UK performance added 2 percentage points of gross gaming revenue to market share of 30%. And the strong growth more than offset a softer Australian racing market in 2023, and the unwind of the prior year benefit from increased player engagement following COVID-related restrictions. And for 2024 to date, so 1st of Jan onwards, they've said they've had a strong trading year to date with group revenue growth of 23.4% versus the prior period. And that included 55.6% revenue growth in the US, with Sportsbook up 63.7%, driven by staking growth and a 230 basis point improvement in Sportsbook net revenue margin, driven by structural margin improvements and higher promotional spend in the prior year on new state launches. iGaming was up 50.3%, carrying product-driven momentum into 2024. The group revenue excluding US grew only 6.3%, and that benefited from diversified geographic portfolio, with the UK and Ireland up 17.3%, international up 3%, and impacted by unfavourable sports results, and Australia as a result was down 8.8%. In terms of the valuation, the business trades at a PE ratio of 57. I did try and look at the last 5-year financials. In terms of the earnings, it's not. I mean, the last year where they actually had positive earnings, that was actually 4 years ago. So I don't think you can really. I don't think there's a normalized earnings to be had here. It's difficult because they are just piling so much into the US, and I think what they've done, I've not gone into town in terms of the research, but I think they've taken on a load of debt, gone and, bought some of these licenses or brands in the US, which are now being written off. And that's where the negative, that's where all the impairments and amortizations are coming from. But in terms of the revenue is almost 12 billion compared to 2 billion 5 years ago. So if you believe they can get those margins that they have had on the UK side and those investments pay off, it's probably actually really, really cheap, even at 50, whatever it is, 57 times earnings. I think this is interesting because this is much more of a direct competitor to Entain, which we have covered. It's a very, very similar story, actually. I hadn't appreciated that this is just, it seems to be industry wide, that they're all just booming on the back of this. So I do wonder if rather than sort of Entain, would you be better with just maybe a basket approach? No, I wouldn't do either because I just don't like the industry. But obviously I know Entain maybe is a bit better because it's got the better MGM, which is obviously more established. But I think if you didn't have any ethical concerns, you probably do quite well in this industry. Because I know 57 times earnings sounds expensive, but then when you look at the growth in revenue, if they can get the margins they were getting before they went into the US, it could actually be very, very cheap. John, what are your thoughts?
No, similar. I hadn't appreciated that Flutter, the strategy was, similar to Entain in that sense. And I don't think that's really, in the coverage of it, emphasized as much until you actually dig into it. And I think there's an assumption on our part that a lot of the revenue is all focused kind of on a saturated UK market, which has had quite liberal gambling laws for, in recent years. Whereas actually it's quite aggressively targeting the States and I guess the growth market as things become, more deregulated over there. I wouldn't have either, but whether I'd have this over Entain, I'm not sure, to be honest. But it does seem to be a growth industry, and I think if someone was looking at it, they probably would do a basket approach with it. Be interesting to see whether any of the others are, following suit, or whether it is just Flutter and Entain, really.
It's interesting as well because if you look at the actual revenue by segment or market by geography, the UK, the revenue is 3 billion. The US is already at 4.5 billion. I think the issue is they're having to sort of plow it into acquisitions and like advertising and stuff like that because it is just so competitive. But it's already 50% bigger than the UK market.
Yeah.
And they're probably still getting going. So the potential is absolutely huge, I think.
And I suppose with these companies, they do have quite a lot of expertise in the sector that they operate in. And you would have thought, and I this is from someone who knows nothing about the industry, that with that knowledge they could go and scale it in the States. But I suppose lots of companies who think that they can do that.
If it's like an established, if it's still been established in the States in terms of sort of relaxing the regulations and stuff, this isn't like, because it's all so much of it's now online.
Yeah,
you don't have that cost, which is probably why they're just plowing it all into marketing, because that's the only thing you can really do to differentiate yourself. People probably aren't, it's not about setting up probably locations.
Yeah.
It's more about just being sponsoring events and being on TV as much as possible. Now, whether that's just so competitive, I think at some point it has to die down, and at some point you are going to start to see maybe more consolidation.
Yeah,
But
yeah.
the problem is if they're all trying to sort of gain market share and then it's all just being spent on marketing to take the market share off each other, is anyone actually, maybe the best way to profit from it is to buy an advertiser? Should we move on to Carnival?
Yeah, so Carnival, we covered it before, not our favourite company. It's the cruise liner, and they had their Q1 results out with Carnival's first quarter revenue increasing by 22% to $5.4 billion, with continued strength in demand driving the ticket prices higher. Underlying cash profit, EBITDA, more than doubled to $871 million and was ahead of guidance. Underlying free cash flow grew from 0.1 billion to 1.4 billion, and that was largely driven by an improved operational performance. Net debt at the period end was at $28.5 billion, which is huge. And first quarter booking volumes reached record highs, and pricing has also been strong. The routing of certain ships from the Red Sea has had some unfavorable impacts, and also there was the event in the news that you might have seen in Baltimore with the bridge, which is likely to have further impacts. Full year guidance for the underlying cash profit was broadly unchanged at just over $5.6 billion. The shares were down around 3% after the results. In terms of valuation, the group has a market cap of £14 billion and trades at less than 0.1 times price to sales, and it has a debt pile, as mentioned before, of $28.5 billion. I wouldn't be interested in cruise lining anyway, but with a pile of debt that big, it would just be uninvestable. It looks like it's recovering well, but I couldn't get away from that really, so it wouldn't be one for me. Sam, what are your thoughts?
Yeah, I mean, we said before on the show, I think once the net debt gets to about 4 times operating profits as a rule, I start to get uncomfortable. And at 3, like there'd better be a good reason it's at 3. This is at about 13. So it's just end of discussion. There's genuinely nothing more to say. I think it's probably going bust unless they dilute the equity holders.
Yeah, no, fair enough. Okay, yeah, well, yeah, okay, McCormick.
Yes, so we've covered them before. They do like spices and herbs and stuff. It's a US listed company with some pretty solid brands, and they have come out with their Q1 results, and sales increased 3% in the first quarter. However, in constant currency, they were only up 2%. Operating income was up to 234 million compared to 199 million a year ago. However, adjusted operating income was only up 5%. Earnings per share were 62 cents compared to 52 cents a year ago, and adjusted earnings per share were 63 compared to 59 a year ago, reflecting a 7% increase year over year. Cash flow from operations through the first quarter was 138 million compared to 103 million a year ago, and the gross profit margin expanded 1.4% versus the first quarter last year. The net cash increase was primarily driven by higher operating income and working capital improvements. So if it's working capital improvements, that's not particularly sustainable because you can only pull that lever once, really. In 2024, they expect sales to range between -2% and 0%, or -1% to 1% on a constant currency basis, so basically flat. They expect a favourable impact from the prior year's pricing actions. Through the power of its brands and its targeted investments, the company expects to improve volume trends as the year progresses to return to volume growth, absent any new macroeconomic headwinds. The company's strategic decisions in 2023 to discontinue low-margin business and divest a small canning business will impact volume growth in 2024. Operating income in 2024 is expected to grow by 8% to 10% from 963 million in 2023. And in terms of the valuation, the business has a yield of 2.23% and trades at a PE ratio of 29. It is down quite a bit, actually. It's down about 25%, I think, from when we last covered it. But I think it was like 38, 39 times earnings then, and we thought it was eye-wateringly expensive. I still think it's eye-wateringly expensive. I mean, the results, I think when it was at 38, 39 times earnings, it was maybe growing sort of like less than 10% a year, which I thought was just ridiculous. It's now basically got flat growth and it's dropped to 28. But then, they're talking about getting rid of the low margin stuff. These are levers you can only pull once, really, to kind of justify a PE of 28. I don't think they actually have a cost base big enough to actually cut it to a level where they can justify the valuation. They would have to do it through growth, and growth is flat. So it baffles me why someone would pay this. I think the only reason it is a quality brand, but you look at the quality brand you can get in Europe. I mean, there's few stocks that make Nestle look like a bargain, and we do like Nestle, but it is expensive. But this makes Nestle look cheap, and Nestle's putting up better results, probably has better brands as well. So yeah, so why you'd pay 28 times earnings for a company that's basically flat growth, I just baffles me. John, what are your thoughts?
No, I mean, similarly, there's Nestle that you could buy. You could buy Unilever, which is better value still. You wanted something that's more turnaround in US, there'd be Kraft Heinz. I'd choose all of those above McCormick. I struggle to see why it's commanding the value that it is.
Yeah, I think you could cut it in half, and with flat growth at a P of 14, it'd still possibly
Yeah,
be quite pricey.
yeah, absolutely. So I don't know. Maybe someone can put the investment case to us, but I'm not seeing it.
So, of the 6 businesses we've covered this week, then Fevertree, Playtech, AG Barr, Flutter Entertainment, Carnival, and McCormick. Which do you like the most and which do you like the least? I suspect your favourite will be a drinks maker of some kind.
Yes, it will be. Ooh, with my own money, I go for AG Bar, but I would be excited by Fevertree. It's just carrying that bit more risk, but if it does properly crack the States, then it is cheap. And then yeah, Carnival is an easy last.
So for me, it's Fevertree first. I actually think it's quite cheap because I do think those costs will be cyclical. Again, without being boring, Carnival easy last. It's the only company where I look at it and think, yeah, that's either going bust or diluting equity. So it is just a very, very easy decision.
Very good. Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.